Hi, this is Sive Morten with the daily update on EuroFX. I post my exclusive market overviews with the key political and economical events, charts, and important levels on the ForexPeaceArmy.com forums weekly. This short video is a response to rapidly changing situation on the currency markets and should help you to stay on top of the game and be profitable. I suggest you to visit ForexPeaceArmy.com forum and read my analysis for the week before watching this daily video.
Welcome everybody, let's take a look again on the gold market. So next week will be really tough to all markets. Recently we already talked about it in our research dedicated to the Forex market. So mostly we have described all events that will stand the nearest 5 days. So the gold market is not an exception. So actually it stands among all the markets that's actually involved and stands as a hostage of these common events. And well, situation stands really tricky because opinion of the investors of the commercial banks, large traders, international banks, so it's really split into two parts, as I talked already about this. So one thinks that the stimulus should support gold as Fed keeps the dovish policy and Biden provides more stimulus. Others suggest that this will trigger inflation and stimulus inoculation of the population, and improving overall situation on this should trigger and boost consumption, spending, and that supports the economy, and this will press on the gold market. And that particular theory that we need to check on the coming week. So we already said how we intend to do this. The data that will be released, particularly speaking, we are watching for consumption and gross domestic product release this week. Next week it will be non-farm payrolls for February, but maybe reaction will happen already this week. We expect the negative numbers on the gross domestic product because United Kingdom already have cut ones, and this will be minus 2.6%. The pulse, at least by the specified in traditional schedule of the economical schedule for data release, suggests that it should be positive, as in the Germany and the European Union and France, as in the United States. Approximately they're expected around 4%. We think that might be at least worse, but small probable it will be even negative. And here's will be very important to keep an eye on the reaction on interest rates. If interest rates will drop, and the impact of the negative statistics, if of course it will be negative. That tell you that recent rally in interest rates, it's some kind of the mostly emotional anticipation backed by the euphoria around Joe Biden inauguration, new stimulus, something of that sort. It's mostly emotional reaction. And the real statistics could bring the cold shower, just chill out this recent sentiment, and everything return back to its own. That will be supportive to the gold. It means that gold stands in favor because stimulus will be provided. No improvement in the economy stands right now. Statistics is poor. It means that no inflation. It means that Fed keeps the interest rates low. But at the same time, we need to keep an eye on the opposite reaction. If worse statistics brings no reaction on the interest rates and they will start to grow or even stay flat, that should tell us something. It means that the further rally on the gold stands at least under question, or in general we're standing in the moment of the major reversal in the markets in favor of the United States dollar growth, in favor of growing inflation, and gold will appear under pressure. Because inflation, it's only the half of the story. So many people tell us that inflation is the driver of the gold. Rising inflation is protection against inflation and so on. In reality, it stands not quite in this way, because rising on inflation suggests rising on interest rates that makes attractive the interest-bearing assets. And that decreases the amount of the investment in the gold. So that's what we need to check out. on the common week. All this stuff, of course, will make impact on the technical picture as well. It's already, volatility is rising, and we have the contradictive patterns on the high time frames. For example, on the monthly, currently stands the question whether we will get the bearish grabber confirmed this week or not, because they will have two opposite grabbers, and so will be two grabbers in opposite directions on the monthly chart. Second, the same story on the weekly grabber, and as you can see on the daily chart, we'll also have the grabber that, yes, it has been formed and it has been completed, and potentially it provides some bearish context for those of you who intend to go short on the gold market. Yes, it looks not as good with this minor pullback up that we've got by the end of the Friday, but in general, we've got the grabber, and also interest rates stubbornly stand above the 1% level, with no downside reversal, no reaction instance in the triangle consolidation, so you could read about it in the weekly report. So, and that's why here now, actually, since everything mostly depends on external factors, on the data that will be released, on the Fed statement, it makes, well, technical analysis some kind of the secondary, put it in the second stage, on the backside. And currently, actually, both sides have the context, both sides have own advantages and disadvantages for position taking. For example, speaking about the bearish position, yes, we have the grabber, we have the high rates, high interest rates that stands tight, which makes the pressure on the gold, and as we expect negative statistics, the normal reaction should be, theoretically, is the drop over interest rates. So that's mostly will be stand in the favor of the bulls. Anyway, here, if no reaction will be on interest rates, the gold could start dropping. And potentially, here technically, well, exists some context for taking the position with the stops above this area, keeping the grabber valid, with the hoping that the market will continue downward action. But that is only for very short-term trading. For longer-term trading, for example, if you trade on the daily chart, on the high time frames, it would be better, if you would like to go short, it would be better to wait the taking out of these lows. Once market will break these lows, the chain reaction will follow. Why? Because here we cancel the hand and shoulders, which means that to cancel the pattern, market has dropped below these lows. With drop below these lows, bullish grabber on the monthly chart will be erased, and we should be ready for a drop at least for $100 to the downside, somewhere to the 1690 area, 17 even, so it will be next leg to the downside. For a long-term position, what we have? On the 4 time frame chart, market has completed perfectly the retracement that we have suggested. As we said, if you remember, in 2 recent sessions, we said it should be deep retracement. And now it's done. Those who have taken the position, well, it's very good. So you could now protect your position with the break-even stop and see what will happen. Here you can see the pullback reaction on the confluence. On the hourly chart, guys, this was also the ABCD XOP retracement. And theoretically, you also could consider taking the long position. As market hits the support, we expect the poor statistics, as I said. Well, who knows how market reacts in this situation. And another attractive moment here that you could place relatively tight stops. So for you, it makes no sense to hide the stop somewhere below the lows or too far. That lows will be enough, because this is enough retracement for a market that supposedly stands bullish. This is XOP at the confidence support and agreement. After the reversal bullish swing, ABC retracement is done. Here's actually, you could probably foresee and recognize the catalyst triple to buy. This reaction has started. So invalidation point for this setup is right here. So if market returns right back down, drop below the lows, it will tell you that hardly will get any rebound, and be prepared for a drop to the lows. That also is useful for bears. Well, as you can see, situation stands a bit tricky. And here we have another option that you need to think about and makes the decision on this stuff. So not only on the direction that you intend to trade, whether you would like to go short or long with this current situation, but also about whether you would like to anticipate at all in all this mess, keeping the position for all releases of the gross domestic product, on Thursday and Friday in Germany and the United States for the Fed statement, because Fed statement could become different. As you know, the Janet Yellen has been appointed, almost has been appointed, as the Secretary of Treasury, and that could make impact on the policy of the Fed as well. So currently it should be more friendly to more stimulus policy, and well, that could make impact, and investors could get some new moments in the speech of the Jerome Powell. So, and that's mostly depends on your risk exposure. So whether you like to do this or not. Personally, guys, to be honest, I do not see so-called really working hard context for taking position in any direction. So personally, I do not see that. I definitely would like to go long or short in the current situation. So yes, we have patrons, but no one is stronger than the other. And in such circumstances, my personal choice is to wait and see for clarity. So, because whatever direction will happen here, it will last for a considerable, significant distance, and it will be cheaper to take the position when action already will start, rather than trying to catch the starting point of this action. So that's some kind of the philosophy, but well, you could make the different view. It also depends a lot from the technical of trading. So, but that's what we have. I'm tell you absolutely honestly what we have currently on the market, and you have all options to think about till the starting of the trading week.